Now, as capital moves across generations, the way that decisions are made is just as important as the decisions themselves. Data has changed the investment landscape, but insight is what truly changes outcomes. So to look at how real-time data and behavioural analytics are refining strategy and improving performance in investment decision-making, please welcome to the stage Taha Khalifa, General Manager for the Middle East and Africa at Intel Corporation, Basma, Rady, Chief Data Scientist at Beltone Holding and Managing Director of Robin, Hasan, Haider, Managing Partner at Plus VC, and your moderator, Hanan Kabat, business journalist and TV presenter at CNBC Arabia.
Hello, everyone, and thank you for joining us. I'm pretty sure you're going to enjoy this informative, exciting panel discussion. And hello to my dear panelists. So let's start. We hear the term data-driven investing everywhere today. If you look at today's market, would you say the biggest risk for investors is not having enough data or misinterpreting the data they already have? I want to start with.
Go ahead.
Sure. I would say the biggest challenge is investing in the data foundation. It's not lack of data, and honestly, it's not lack of AI. There is too much AI tools and too much AI noise, and there is a lot of data. And what companies need to invest in is building the right data foundation to make sure they can actually capture the insights needed for decision making.
Interesting. Mr. Taha, you want to add something?
Yes, fully agree, because there's no lack of data. We've created a term, and I think it's been overly used, which is data is the new oil. But what kind of data? It needs to be clean, relevant, updated data that can be used by the organization to have real insights, to create the real insights and enable it to make informed decisions. And this requires, it's the first step of any reasonable AI implementation. So both lack of data or not using the data will not help the organization.
Thank you so much. Mr. Hasan, where are your thoughts?
Yeah, I think data is just table stakes now. You really need to understand how to utilize the data that you have. Every company has loads of data, but it's all siloed, it's not properly structured. It's understanding that data and utilizing that effectively for your business, which is one of the most important things and hardest things to do with AI right now.
Thank you so much. As you said, we need to understand this data. So let me go to Mr. Taha. How is the convergence of real-time data, AI, and advanced computing reshaping how investment decisions are made across different asset classes?
Well, what we've seen over the last few years, and especially the last few months, is the impact of AI, and especially generative AI, and we've seen a lot of that. However, AI has been in existence for a while, and it's been used widely in many organizations, and especially in the investment community and in the equity markets in order to do some predictions and also to enable them to take fast actions. However, the increases that happened over the last few years with the inception of new large language models, generative AIs, and the abundance of real-time data that does not only capture what's happening from a market perspective, but there is an abundance of data coming from things like satellite imagery, supply chain signals. All of these give a different perspective of how the markets are moving and can really influence the market and accelerate that. So what's happening, especially in the asset management, is three things. Is moving to more predictive, real-time, continuous asset management. That's number one. and this is a result of the availability of this data. Then number two, your ability to increase operational efficiencies. As you go through these types of new activities and programs in the system, you're able to increase efficiency. Things like transaction settling, regulatory compliance, all of that enable you to make very informed, very fast decisions. And this would lead, again, for you to offer services that are more personalized, more real-time, more predictive to benefit your customer. However, as this builds into place, there are two key areas that you need to be aware of. Number one is security, which I think is something that is going to be very critical in how security blends with AI. And then the last one is the ability to use personalization in a very defined way without violating some of the privacy constraints and having explainable AI.
It's good to see this from a technology perspective. Thank you so much, Mr. Taha. But going for Mrs. Basma, since you're a chief data scientist, from your expertise, how is real-time data and AI changing the way investment teams make decisions under uncertainty as well?
Well, within uncertain times, it's never about the quality of the predictions, right? This is not about making better predictions. It's about ensuring that predictions are part of ongoing decision cycles for asset managers. What we do within Robin is we actually equip asset managers with different types of models, right? So there are models to forecast volatility, but there are models that will also give you signals as to where the market is going. And then there are models that are helping asset managers detect anomalies in the market, anomalies in terms of stock market behavior. So it's actually not about one model or one tool, it's a suite of tools that are actually allowing asset managers to have ongoing decision cycles that are powered by the right data and the right AI signals. And one thing to note here, when we build the suite of AI tools that are powered by real-time data, by definition, we set up the right guardrails for AI. When we talk about AI for investment decisions, we have to have the right guardrails and to make sure that human-in-the-loop component is always present so that as these volatile markets are happening and while equipping the teams with all these tools and setting the right guardrails, that there's also human-in-the-loop component to make sure that investment decisions are at the end of the day governed and owned by an asset manager.
But don't you see there are so many risks with the AI tools here?
Look, there are risks with AI tools if you don't have the right guardrails, right? When you don't have the right guardrails, when you don't understand why a certain tool or model is guiding a certain decision, a certain investment decision, when you cannot explain it and when you cannot control it and monitor it, then it becomes too risky. Otherwise, when you set up the right guardrails, then it's almost as if you're getting all this value while minimizing the risk.
Thank you so much. And now moving to Mr. Hasan, in venture capital and alternative investments, how do data and behavioral insights complement traditional judgment and experience?
So I think venture capital is, by its nature, it's a broken asset class because most of the people that are investing in VC all think they're amazing stock pickers. But that's not really the case because the data says something else. And so the way we've built our entire fund philosophy and process is built on the data that tells us actually what you should be doing in venture capital is investing in a broad portfolio. So we know the data of the probabilities of success in VC, and to do anything different would be honestly shooting ourselves in the foot. So the way that we look at it is we know in venture capital, out of 100 companies, 60 of them will go to zero, no matter what you do. You can try and rescue them, and I did when I started in the asset class, but I don't anymore. There's nothing you can do to rescue those 60%. Then there's another 20% that give you back your money, and that is worthless as well, because you're not investing to just get your money back. So 20% of all investments in venture capital are what generate all of the returns. So a lot of people build portfolios that are too small from a data perspective to make sure that they're getting access to the outliers that are going to generate a return for them. Within the top 20%, we know that about 10 to 13% of the time, you'll generate a return of about 5x. 5 to 7% of the time, you'll get the outliers. They'll generate a 20x return. But in VC, what we're aiming for, what we want to invest in, is startups that will generate a 40x return or more. Those 40x returns only happen about 1 or 2% of the time. So we have the data, it exists, but most VCs still are focused on, we'll do 20 to 30 deals, that's enough diversification. It's really not. You need to invest in at least 100 companies according to the data, and that's kind of what we do. We look at 2,000 deals a year. Out of those 2,000 investment opportunities, we invest in about 30 or 40 and build a large portfolio of at least 100 companies that the data says will have a reduced risk that people are worried about in VC, and will generate more consistent returns across funds, across time periods. So data is like at the core essence of how we have defined what we do as a firm, because most people ignore that probability distribution. And that's, for me, doesn't make sense as an investor, right? Like, you know what the probabilities are. You gotta maximize your potential for returns.
Thank you, but if we want to clarify more to our audience, how can investors use this data-driven frameworks to better assess founder behavior?
Sorry, what was that?
And how can investors use data-driven frameworks to better assess founder behavior, decision-making patterns?
It's hard. Most of what I do as a fund is really investing in people, and you can't, like, there's no, like, I tried once where I was like, oh, where are they on a scale of 1 to 5 on, are they active, are they nice, are they idiots? Like, you know, it's difficult to kind of like put everyone into numbers. So I am a very data-driven person, so that's why we've built the fund structure the way it is. But when it comes to individual opportunities, what we're investing in is we're investing in people that have the potential to build and scale and execute and get things done. And that's hard to quantify. Even though I want to quantify it, it's just not something that's easy to quantify. But what we look for is signals of their ability to execute, and within that there is data. It's like, have they been able to acquire users? Do they understand how to effectively acquire users? What do their unit economics look like? What does, you know, all these sort of the numbers that we can get at the early stages, we look at those very carefully. But honestly, in VC, your best opportunity is to invest in a broad portfolio and diversify out that risk. That's really, you can't diversify out the risk on a single company or a single opportunity, but you can diversify it from a portfolio perspective. And I think that's where a lot of people that go into VC or startups, they make a mistake because they'll invest in 1 or 2 deals. They'll both fail, obviously, but essentially you're not giving yourself enough opportunities to generate a return over a portfolio construction sort of basis.
Thank you so much. And moving forward to Mr. Taha, from a technology perspective, what capabilities are most critical for turning large volumes of data into action? And especially if you want to talk about into action for advisors and investors nowadays.
Exactly, and this is why you have to make sure that the data that you have is the right forms of data. So it needs to be clean data, it needs to be relevant, and it needs to be mapped into your organization and into the type of investment community. This data can contain areas that are structured and some data that is unstructured. So even some data related to social media, etc. Number 2, this data needs to be continuous because you need to continue having all these signals from the market. There's a lot of noise that is coming from the market. There's a lot of signals coming from the market. So your ability to have all this data input, prioritize it, and make sure that this is part of your decision-making process. With this data, you need also to have the right analytics tool that gives you all of the information that you will need to do. And part of that analytics tool, there needs to be some explaining element, and this is why when Basma referred to explainable AI, this is something that is very important, especially in the investment community, because you need to be able to understand why such decisions are made. And I think also she referred to the human factor, to be able to have this ability to explain and to drive on that. Then there is also one area that is very critical, especially in the investment community, is the governance. So governance is something that is very critical in the investment community, where the data is, so data sovereignty, some of the rules, security, traceability, all of these elements in order to meet some of the regulatory aspects of this data. These are some of the areas that you need to be aware of as you build kind of and clean up your data and to have it as a core for your organization, and then it represents the core value for the company.
Thank you so much. And now let's move to the challenges here. So what practical challenges do financial institutions face when embedding data-driven and behavioral models into everyday investment decision-making?
Wow, where do we start? All right, I'm going to start by referencing an MIT study that talks about the Gen AI divide. So basically, it goes like this. Only 5% of companies in the study were actually leveraging the full potential of AI, where the remaining 95% were not able to do the same. And that's not just for financial institutions, that's across many, many sectors. And the main difference is actually in the AI capability, right? So most companies that don't invest in AI capability, whether in-house or outsourced, if you don't have that AI capability that's going to actually build the right data foundation, connect to all those data sources, have those conversations with the investment managers and the asset managers in order to make sure that whatever models are built, whatever tools are developed are actually useful, reliable, trustworthy, and more importantly, are going to help you beat the market, right? So the main challenge is investing in that capability, realizing that this is a necessity, and not thinking about AI as an out-of-the-box tool, something we're going to unwrap and unpack and then plug into our systems, and all of a sudden it's going to be like magic, it's going to start working. That's the biggest challenge. Breaking that misconception for business leaders and for executives, just to make sure you can get from a place where there is a lot of potential to actually realizing that value after going through that journey with talented AI capability.
Thank you so much. And in your experience, what's the biggest misconception institutions have about using data and behavioral analytics?
All right, there are a couple of ones. The first one is most people don't think they have enough data. Most organizations, actually, they don't think, and when they say that, they usually mean they don't have good quality data. And I think this is something Taha mentioned before. Well, good quality data is not just going to fall into your laps. You're going to have to work for it. You're going to have the right AI capability that will help you turn data that's not structured, that's largely not clean, that has a lot of issues because the systems that were used to collect this data have flaws by design. Now, this talent and this capability is going to allow you to use that data properly. So the biggest misconception is it's going to happen naturally, and it's not going to be a big deal. And the second misconception is, as I was just saying, a lot of companies think that AI is just gonna work for them without doing all that investment and doing all that hard work.
Thank you so much. And Mr. Taha, what are your thoughts? What are the misconceptions here?
I think the key misconception, as Basma said, is that people use AI as like a panacea, like if I use AI, it's going to solve all my problems. But the whole thing is AI is a tool, and it's a very highly efficient tool if used in the right place. In fact, it's a critical tool. I think what we're going through AI right now is very similar to the internet in the 2000s. Companies that use the internet were successful. Companies that do not use the internet have ceased to exist, and they need to use it to improve efficiency and productivity, not just to use the technology.
Thank you. Last but not least, we're running out of time.
Of course. So the thing is that AI isn't, like both my panelists said, it's not a one-size-fits-all. So when we're investing in startups, we're not looking at LLMs or in general AI. What we're looking to invest in is specific AI startups that are solving problems for specific industries. Because although AI is a cool new technology, it's a technology like anything else. It's table stakes. So the sales process of getting into companies, the understanding the sector, all these sort of things are still there, whether it's an AI startup or non-AI startup. So you have to have specific sort of insights in the industries that you're going after. So generalist AI doesn't quite work.
Thank you so much for this insightful panel discussion, and thank you all for joining us.
Thank you.
Thank you.
Thank you.